Next topic, pensions. Types of pension schemes: occupational pension scheme and personal pension scheme. Occupational pension scheme is set up by employer for the benefit of employee, and in this form of pension scheme, the employee's contribution is allowable deduction while employer's contribution is exempt. Personal pension scheme. It can be set up by any individual for the benefit of himself or for the benefit of others, employed or self-employed, or any third party. Employee's contribution extend the basic rate band, higher rate band, while employer's contribution is always exempt. How to calculate tax relief on contribution? First, you have to calculate the maximum annual amount, which is higher of 3600 and 100% of relevant earning. Here, relevant earning means employment income, taxable trading profit, and also income from furnished holiday letting, but it does not include investment income. Then after calculating maximum annual amount, compare the maximum annual amount with gross pension contribution. Whichever is lower is said to be amount qualified for relief. And for calculation of the tax relief, the amount qualified for relief is multiplied by 20%. Individual has to pay gross contribution minus tax relief. So this is an example from Kaplan book. The pension contribution, gross pension contribution and trading profits are given. There are no other income of that these persons given to us. They have no other sources of income mentioned in the question. From the first line, the following individuals made gross pension contribution into a personal pension scheme in the tax year 21-22. Let's about Andy. Andy has a pension contribution of 5,000, but he has no relevant earning. So let's see. If he has no relevant earning, then the maximum annual amount would be higher of 3600 and 100% of 0 means 3600. Then we need to compare the maximum annual amount, which is 3600, with the gross pension contribution, which is in Andy's case 5000. So whichever is lower between 3600, the maximum annual amount of Andy, and the gross pension contribution 5000 of Andy. Whichever is lower is amount qualified for relief. So it will be 3600, and you have to multiply 3600 by 20% to calculate the tax relief, which will be 720. Now what individual has to pay? 3600 minus 720, this is 2880. So this is how we have to calculate what the individual has to pay or what is the tax relief. Again, first you need to compare the higher of 3600 and 100% of relevant earning. Whichever is higher is maximum annual amount. Then this maximum annual amount is compared with gross pension contribution. Now whichever is lower is amount qualified for relief. In the case of Dawn, let's see. In case of Dawn, the contribution is 40,000 and the relevant earning is 95,000. So contribution is 40,000 and relevant earning is 95,000. So in the first case, where we have to calculate the maximum annual amount, higher of 3600 and 95,000 would be 95,000. Compare this 95,000 with the gross pension contribution, which is 40,000. So 95,000 and 40,000, whichever is lower is amount qualified for relief, and it will be 40,000. To calculate the tax relief, multiply this 40,000 by 20% and you will get the tax relief amount 8,000. Same is the case of Ed. Ed has a pension contribution of 60,000 while trading profit is 25,000. So tax relief is available on 100% of relevant earning, and they have compared this and find it out that 5,000 is the amount of relief and 55,000 is the contribution that Ed has to make. Then there is an annual allowance. This is 40,000 for the year 21-22. But it can be increased. How it can be increased? It can be increased by bringing unused allowance brought forward from previous 3 years on FIFO basis. Here, point to remember is that the unused allowance can be brought forward from previous 3 years if the pension schemes are registered, otherwise no. Now, what if total contribution exceed annual allowance? The excess is taxable, which is known as annual allowance charge. There is a restriction of annual allowance, just like personal allowance and child benefit charge. You have to calculate the adjusted annual allowance, but it is based on adjusted income, not adjusted net income. This is adjusted income. How to calculate the adjusted income? It is net income plus employees' contribution into occupational pension scheme and employer's contribution into any scheme. Means either occupational or personal pension. How to calculate the restriction? First, you have to identify adjusted income in excess of 2,40,000 divided by 2 and subtract that amount from 40,000. But remember that this will reduce the annual allowance to maximum 4,000, not below 4,000. For example, if the adjusted income is 2,90,000, in the first step you have to identify how much portion of adjusted income is in excess of 2,40,000. So it is 50,000 divided by 2 and you will get amount of 25,000. And now subtract this 25,000 from annual allowance of 40,000 and you have 15,000 of annual allowance available. What if adjusted income is 3,10,000? In that case, excess portion is 60,000 divided by 2, you will get 30,000 and subtract 30,000 from 40,000 and you will get the adjusted annual allowance as 10,000. In case 3,12,000, again the excess portion is 72,000. No, in that case, in fact, it is 70,000 and half of this would be 35,000. And when 35,000 is deducted from 40,000, you will get 5,000. Then 3,12,000 minus 240, it will give you 72,000. Half of this is 36. And when you deduct 36,000 from 40,000, you will get 4,000. Remember that if adjusted income is in excess of 3,12,000, you don't need to calculate the adjusted allowance. It will always be 4,000. For the calculation of unused annual allowance of previous year, this is very important. Test your understanding 2 from the Kaplan book. And in this test your understanding, as your contribution is in excess of annual allowance limit, so the excess portion is chargeable to tax. Remember, wording is quite important. For example, in this question, test understanding 5, the first portion about Excel is quite easy to calculate. The second paragraph, Ingrid is employed and has an annual salary of 2,90,000. Has an annual salary of 2,90,000. Previously, they have given us the taxable employment income, not annual salary. It is taxable employment income. And while in test understanding 5, they have given us the annual salary. She also has a dividend income of 8,000. In 21-22, she paid 10% of her salary into her employer's occupational pension scheme and her employer contributed 5% of her salary into the scheme. Remember, as his or her annual salary of 2,90,000 is given, so we don't need to add back the 10% percentage of contribution by employee into it. It already included in this amount. So you have to add only the 5% contribution by the employer and the 8,000 of dividend. Now about accessing pension fund. Once invested, funds in a registered pension scheme are accumulated and can grow in value tax-free. Individuals with the money purchase scheme have complete flexibility in the way in which they can access the accumulated funds in their pension scheme when they reach the pension age. They can withdraw 25% of fund as tax-free lump sum. The balance of the fund can be accessed in a variety of ways to suit their individual circumstances, but withdrawal from balance of the fund are taxed as non-saving income at the normal rate of 20, 40 and 45%. Lifetime allowance. There is only a limit upon the annual contribution upon which tax relief is available, and that is 10,73,600. Now, what if the value of pension fund exceeds the lifetime allowance? An additional income tax charge arises on the excess fund value when the individual withdraw funds from the scheme.